Hi everyone. We're just going to wait a minute or so for some more people to join, and then we'll get started. I see that we've got quite a few already on, so it's pretty good. I'll just give it probably another 30 seconds, and then we'll get started. All right. Looks like we've got a few people on already. So I guess thank you very much for tuning in. We've got a pretty, jam-packed session today to talk with the Executive Director of SV Partners Queensland, David Stimpson, and he's kindly decided to be, I guess, our little guinea pig on this trial that we're trying to run on LinkedIn Live. Thanks everyone for tuning in. It's pretty awesome that we're able to do this. So basically what SV is doing, we've set up this thing called SV Live. SV Live will be simulcasted to LinkedIn, Facebook, YouTube, Instagram, maybe Twitter one day. Basically, we're trying to give as much free education as we possibly can to the masses, particularly the business owners and that are clearly struggling at the moment with all of the COVID restrictions. We're very much happy to give as much free information as we can. We would highly encourage anyone to check out our website at svpartners.com.au. There's heaps of resources, free guides, FAQs, and anytime feel free to pick up the phone to someone like David or myself to talk about or even just brainstorm some ideas to help you get through everything going on. So what you'll find over the next few months at least is a series of live broadcasts that will go out to the nation, really, talking about all things insolvency, restructuring. We'll have some pretty awesome guests that are going to join us. As I said, David's the first guinea pig, it wasn't too hard to try to convince you to join, but
it's much trepidation, Matthew. But anyway, I'm hopefully enjoying the ride.
Yeah.
So,
well, it should be good. We're going to try to see if we can rope Terry Vanderveld into it one day, but that might be a bit of a stretch. So you'll definitely find over the next few months, maybe a lot longer than that, where we're going to really try to push this. So definitely stay tuned to watching the SV Partners page and my LinkedIn page. There's heaps of information there. Basically, I want to introduce David Stimpson. So David was actually my first ever director when I first started here at SV back 2011, late 2011. He was my director for 8.5 roughly years. So it feels like forever.
Eight wonderful years.
Yeah. So we had, plenty of work we've worked on together in that, and that's why I thought it would be, awesome to share some of your war stories over the last 30 years. But I guess before we get into that, I thought you might want to just share a little bit about your early years, some things about why you wanted to join insolvency, why did you want to become a registered liquidator about 15 or so 20 years ago, and a registered trustee 5 or so years ago.
Thanks, Matt. Yes, well, thank you for the invitation. Hopefully can keep you reasonably entertained and informed. I am a novice, as Matt has pointed out, to this new age of technology. I opened up my LinkedIn my LinkedIn email this morning, and I had 75 unread LinkedIn notifications. So this is my first step of many steps to get into the 21st century, as Matt pointed out. I started in insolvency about 30 years ago, so actually a bit more than 30 years ago, 1988, in fact, roughly 6 months after the share market crash in 87. So it was a hotbed of insolvency throughout the nation. I started working for David Clout, in fact. He was my first partner, and his partner was Bob Tuckey. at Ferry Hudson. We were called Ferry Hudson, Brisbane. One of my first jobs was working on Rothwell's Merchant Bank. It's a listed company. Ian Ferrier and Bob Tuckey got appointed as liquidators to that company. My first job was to, well, I wasn't really sure what I was doing. In fact, Bob sort of breezed past my office threw an exercise book at me and said, just sit by the phone and answer it and take down the names, contact details, and the amounts owing for every creditor who rings up. And I think I got out of there at about 11 p.m. that night. So I was actually packing up, ready to go. And he's like, no, you're not going anywhere. So the proverbial hit the fan. And so it was an interesting sort of foray into my first step into insolvency. The next day I had the job of their office. The head office was in Perth, but they were registered in Queensland. So as a result, we had to have a Queensland liquidator. So my second job was to clean out the office, which was next door at 10 Market Street, in fact. And I remember the boardroom was fully stocked with, premium scotch and whatnot, and that was quite exciting. Didn't drink any of that in those days. I was young and just on the beer at that point, I suppose. And I remember they had a bathroom in the middle of the office, and it was like, wow, this is pure luxury. And I also remember they had gold taps. There you go. So cleaned out the office, and then my only other role in that job was to be walking around at the creditors meeting with the microphone while Ian Ferrier held court. So it was quite exciting as a youngster. So that was about 30 odd years ago. Worked for a couple of good bosses since then. I'll give them a plug, Phil Jefferson, and then did a bit of travelling. Travelled for a year overseas, which was good fun. Took some time out, got away from the CA, which was sort of quite annoying at that stage. Came back and I did and don't hold this against me, I shouldn't say that. Did a 6-month contract at AFSA, then called ITSA, doing trustee reviews. So that was quite interesting.
I'll make sure to tag them in the video.
Quite interesting. I spent a few years with Ivor Worrell and Raj Khatri at Worrell's, which was a good time. Enjoyed that. Enjoyed working for both of them. Enjoyed playing squash with Raj. That was fun. And then for the last 20 odd years I've been SV Partners, Hall Chadwick. So enjoyed the ride. I've enjoyed the time. Still enjoying it, in fact.
And what, I guess, made you want to stay as part of it, be part of that into the insolvency industry, as it was like when you would have started, it would have been in the, I guess, sort of the early days, almost like the Wild West before the even Corporations Act was in force and stuff like that.
As a uni student, I was lucky enough to talk to a partner at Deloitte's, and I think he was the audit partner. And I wasn't real flash at audit and tax at uni, so I sort of said to him, I'm sort of pretty keen on, it wasn't an interview or anything, I was just talking to him. I said I was pretty keen on doing insolvency. And he's like, insolvency, that's where they're the guys who have the most fun and make the most money. And it was a bit of a throwaway line, and I just sort of went, that sounds good. So
I do remember you telling me that story many years ago.
Yeah. So from that point, it's funny the way sliding doors and the way things can sort of stick in your mind. So that was sort of what got me interested in it. Then honestly, the first couple of years with Cloudy and Bob were awesome. I was doing all sorts of stuff that was way out of my comfort zone. The first 2 years, I think I was involved in the trade-on of a sawmill. These were decent-sized businesses. Pinker Bar Hotel, Chinese restaurant on Hamilton Island, which
maybe for those on the audience, if you could maybe just explain what a trade-on is, and from the perspective of how that might help a business owner and stuff like that. 'Cause there might be some people who probably don't understand what you mean by trade-on or sawmill.
Okay. So the trade-ons are often a receivership or a voluntary administration. Voluntary administration will be triggered by a director who comes to the realisation that the business is in strife and they need some help. So they appoint a voluntary administrator. In that situation, we would come in, do a due diligence on the business, if you like, and then make the decision of whether we can continue to trade the business and put together a deal for the creditors and hopefully get the company out the other side, or maybe it would involve a sale of the business as a going concern, restructure of sorts. So during all of that period, as the administrator or the receiver, my role is to continue to keep the business trading, and that's what we call a trade-on. So, so my first 2 years I had probably half a dozen trade-ons, and quite complex matters, which, I obviously didn't do everything on them, but I was quite heavily involved in all of them, and it was busy and it was fun. It was exciting.
Yep. Okay, well, we might continue on with this trade-on story because I do want to go through some of these war stories and that, but the reason why I keep picking up my phone is I'm just trying to keep watching to see if there's any comments or questions coming through, and I would highly encourage anyone who's on watching this live broadcast right now, feel free to send comments or questions through to David or I at any time, and I'll make sure to ask him if I think it's appropriate or relevant. So I haven't seen any come through just yet, but feel free. So just talking about those trade-ons and that, you sort of gave me a bit of a rundown of some of your, favourite jobs or interesting jobs over the years and that. And I think there were two particular trade-ons that sort of stood out to me, both one in the traffic services industry and then the other one in the trucking business. And I think they were sort of like polar opposite, in the sense of risk reward, but still in effect got a pretty good result for everyone. So could you just maybe fill everyone in a little bit about what happened on those jobs, and maybe try to also relate it back a little bit to like why trade-ons can still work, and that an external administration is not the end. It can certainly mean that you potentially have a second chance, and it can be the best outcome for you. So.
Yeah, well, I think when it comes to transport and logistics, trucking businesses, when it comes to trading them on, there's pretty well one rule, and it's don't. I've been involved in quite a few trade-ons. One was in the very early days of the VAs, dockers, and we put together a docker. Did a lot of work, traded the business on probably over a good 2-year period, and got the creditors 50 cents in the dollar. But it was pretty good, and it was a hard slog. Took a lot of negotiating with the creditors and a lot of communicating with them to keep them on board throughout that period, and it took a lot of work from the director. We worked well with the director, so that's one of the keys to a trade-on is striking up a rapport with the director, showing him that you're fair income, and that if he calls you at 1 a.m, then you take the call. But on the whole, I would tend to avoid trading on trucking businesses, but that's not hard and fast. One of my favourite jobs was a company called Traffic Services. It was a stop-go business. This was in the early days of stop-go. And this company had probably 70-80% of the market in Queensland of the traffic control industry. It had because it employed 400, 500 employees, it had large payroll tax, large PAYG and super and so forth. And so those debts were quite substantial by the time we got appointed. We traded that business on for probably a good 3 to 6 months during the VA period, put together the docker. The docker got through, and we monitored the docker for some time. It was starting to head south, so we stepped back in and took back control.
So maybe when you say that it's going south and that, maybe explain for those listening and that around sort of what's that liability like for a particular VA when they're trading on, the risk that they take on, and then once the deed of company arrangement is put together and that, how that sort of risk transfers over to the directors or those who are the proponents of that.
Yeah, sure. So during the voluntary administration VA period, I'm personally liable as the administrator, and that's a fairly high risk that we have to take. So we have to be pretty confident that that we can trade profitably. Otherwise, it comes out of our back pocket if there's any losses.
So there's a lot of cash flow forecasting and
there is a lot of background work done to make sure that the business is viable going forward. One of the benefits of a VA is it freezes all the old debt, and that gives you a bit of a cash flow boost going forward. So during that 3 to 6 month period, there was a lot of work to get our heads around the financials and the operations side of the business. It's the only VA I've done where we moved premises in the middle of it.
Oh, really?
Including signing up a new lease. Unusual, but managed to do it. Anyway, that's an aside. Once you get to once you get to the end of the VA period, the creditors decide whether to. I'm not sure whether I need to go into this detail, but pull me up if I'm going too much. Once you get towards the end of the VA period, you call a meeting of creditors, and they decide whether to accept the deal that's on the table.
And that deal is that deed of company arrangement, docker.
And the deed, and I can't remember the specifics of it, but essentially it was to repay X portion, a substantial portion of the debt over a period of time.
And they're normally like 12 months is probably a normal 12 months to 2 years sort of range. Occasionally you might see a 6 month or up to maybe 3 years sometimes, but it's generally in that sort of 1 year to 2 year range. Yeah,
in the early days it was fairly standard, 2 to 3 years. 3 years was quite the norm. But I think we realised over time that's just too much of an impost on the directors and the creditors and everyone involved.
And that's really because the business has to fund that. Say they're paying $20,000 a month or $10,000 a month into this deed fund to pay to the creditors, and that 10 grand or 20 grand needs to come out of their cash flow as they're moving forward a lot of the time. So it's and that's why I was sort of saying you sort of see it within that 1 to 2 year bracket because
and one of the tricks is that for the company to fund that 10 or 20 grand a month in docker repayments, they often rob the tax office to fund those payments. So you've got to make sure that the payments are being made, but you've also got to make sure you monitor that the taxes are being paid and the super's up to date. And on this particular file, the taxes were starting to fall behind again. So we came back in, took back possession of the business whilst it was in docker, and we put it on the market to sell it as a going concern. This was sort of early 2000s, so it was a fair bit of money around, and there was a lot of interest in the business. It was a good business, 25 million turnover, stack of assets, pretty good balance sheet, but it just needed working capital. Long story short, the buyer ended up wanting to acquire the shares in the company, not the business assets. So he wanted to acquire the company and then list it, um, and to use the funds that he raised from the listing to pay the creditors, which we thought was a great idea, except for one problem, and that is you cannot list a company that's under a docker or in administration. So we then sort of sat down with the lawyers and we worked out this new thing called Creditors Trust that was happening over in WA. So we put together a Creditors Trust, which essentially quarantined the debt in the trust, as you might know, and then allowed the company to come out of the docker, list, raise the funds, came into the Creditors Trust. We ended up paying 85 cents in the dollar to creditors. So it was a magnificent result, and I think it was probably one of the first Creditors Trusts that was done in Queensland.
That's really cool. Yeah,
it was a good job. Yeah. So that's sort of. I've got many other trade-on sort of scenarios. I've had one recently, which again was a similar situation. We put together a docker proposal. The business was transferred to a white knight. The white knight essentially contributed sufficient to pay out the creditors in full. The business owner's got to pay out, the shareholders got to pay out, the creditors got paid in full, and the business is still trading.
Wow.
That was a very good job.
Yeah. So I guess for those listening in that, I think one of the things that I hear from people quite regularly is that they're really concerned about external administration and the negative press and the negative, I guess, implications it can have on your business. And that, and obviously, you've just described two out of many that have actually successfully been done. So maybe you can just share some thoughts around maybe how to overcome that stigma, or that this is actually a very viable option.
Yeah. Well, it's pretty important to be honest. And I think there was a lot of scepticism about VAs and dockers in the early days, or maybe even still now, where they were being used in circumstances where, the leopard spots hadn't changed, the directors hadn't made any changes to the operations. There was no real restructuring that had happened. It was really just an exercise of kicking the can down the road, if you like, to keep their business alive. And so I think there's a bit of cynicism around the use of VAs. I think it's important to be honest and to be frank with the creditors and especially the directors. If it's not going to work, if it's a dog, you've got to tell them it's a dog.
Yeah.
And don't kid yourself. And I think the industry has learned that. And I think we're a lot more judicious in our approach with VAs and dockers, but they are certainly, they certainly work. And you've got to do the background work to put it together, often before you're appointed.
Awesome. All right. Well, I think we might move on from dockers and that. I was just checking to see if there's any comments or questions from anyone online in relation to that. But feel free to send them through. So what I wanted to talk about next was ASIC put out the other day an announcement around how many prosecutions they've had recently on directors and people who aren't complying with liquidators, who have committed offences and all that type of stuff. And it seems to me that we've come quite some way in creating laws and reforms around, director identification numbers that should be coming in soon. The new ASIC illegal phoenixing reforms that came in February, March, and we'll go through that a little bit shortly. But there seems to be all this reform in that. And when I was going through, I guess, the list that you put together for me of some awesome war stories and that, there was some in there that sort of talked about illegal phoenixing and frauds back in the 90s and the really early days of even before the Corporations Act wasn't even brought in until 2001. So so maybe my favorite one of the list was, because I'm a massive Star Wars nerd, was there's a company called, I do want to read this out, Skywalker Proprietary Limited, trading as Jedi Futons. So if you can maybe just talk me through a little bit about, I guess, firstly, maybe some of the story in that, and then maybe explain for those in the audience what an illegal Phoenix is, and what were the outcomes in particular with that business, and who it was sold to, because that's also awesome.
Yeah. So we got appointed as liquidator. It was a Creditors voluntary liquidation to this company called Skywalker Proprietary Limited. And as is often the case with these questionable matters, it was just south of the Yatala, invisible line, if you like, I suppose.
Yeah.
Actually, it might have just been north. Anyway. Yeah. So it traded as Jedi Futons. I don't know if everyone knows what a futon is, but it's a little Japanese bed, basically, isn't it? I think it doubles as a couch. And I was like, how the hell can you make money out of selling that? Who buys a futon? Does anyone? This is the 90s as well. So anyway, so I went down and the referrer said, listen, the business has been sold. Here's the contract. And here's a few other records and information and so forth. And I've gone through the contract. Is this for real? Is this a piss take? This can't be real. It's and this is I think early to mid 90s, I think. Anyway, so the contract basically said business is being sold to purchaser for X amount.
I have to ask, what was the name of the purchaser?
Well, this is really what sort of alerted me to, what's going on here. The purchaser's name was Chewbacca Proprietary Limited.
I love it.
And I just said to the referrer, like, honestly, if this is arm's length, I'll walk to Bert. There's, the Chewbacca's obviously a related party. It's all related. You didn't even try to hide the fact that this is a Phoenix. And he sort of just brushed it aside. Anyway, long story short, there was a sale contract, an evaluation of sorts done, and it was set up to an extent. And this is no joke, the first Phoenix I came across in a job that I'd done.
Yeah. And so maybe just explain what a Phoenix means to you, and maybe also to the extent that not all Phoenixes are illegal, so to speak. You can potentially sell your business to a related party in certain circumstances. But maybe just explain a little bit what you mean by an illegal Phoenix.
So you just about classify this one as an illegal Phoenix, I think. It's a bit line ball, and it depends on the circumstances. So a Phoenix essentially is where a company that's in strife transfers its assets to a related company and then goes into liquidation. The related company usually has the same shareholders and commonality of shareholders and directors, and they continue to essentially trade the business using the same assets, having dumped the old company and the old company's creditors, and they trade on into the future. The distinguishment between just a Phoenix, if you like, that is a proper term, and an illegal Phoenix is just basically whether it's a commercial deal or not. So you can have a Phoenix where fair value is paid, market value is obtained, the funds are used appropriately and paid to the creditors.
Yeah.
An illegal Phoenix obviously is where the assets are traded at undervalue or for no value. So in this case, it was certainly market value. It was above market value, in fact. But the terms were that the purchase price wasn't going to be paid for 5 years, and no payment was going to be made for 12 months. And it wasn't hard to read between the lines that. The other thing is no security was given. So often with vendor finance, which this was a form of, the vendor, the purchaser would give the vendor security over the company and over the assets going forward to secure the purchase price. There was no security, and there was no payment for 12 months. And I sort of read between the lines and thought, well, this thing's probably going to fall over within 12 months. So I either challenge it under avoidable provisions, or I negotiate better terms. I got legal advice, which was if they give you security, then it is relatively commercial. So we were given security. They made some payments. They accelerated the payments as well, and then I think they got sort of 18 months down the track and they fell over. And we negotiated a settlement, and that was pretty well in. But I just the names were fantastic. I just loved it.
I love it as well. So we do have quite a few other illegal phoenixing and fraud stories here, but for the benefit of time, I think we might skip over a few of those. But I think a lesson here for directors, business owners, creditors, and that. I think it was about February last year, ASIC brought in new rules around illegal phoenixing. So there's a whole load of reforms there. I guess some of the key reforms were, so you were talking a little bit about the illegal phoenix, I guess, definition. And ASIC's made that a little bit broader now, where it effectively can be either fair value or fair market value or the best offer, effectively. So you've made genuine attempts to try to sell the business and whatever that best offer, relatively speaking, is. So as long as you're either meeting one of those two tests, you're generally not going to fall into that sort of illegal phoenixing category. But I thought what was quite interesting as part of those reforms is those, I guess, almost like the equivalent of what's called a 139ZQ notice for bankruptcy is now available for ASIC. So maybe if you could just explain, maybe not so much the 139ZQ, because hopefully one day that name gets changed. But the more the ASIC notice, and have you seen anything where someone's lodged one of those or anything like that?
No, but I've got one brewing.
Okay,
so it's not an area of expertise at this point that I would say I would have. But I obviously understand the concept, and I've done a number of 139ZQs. They're a great tool if you can act fast. You need the evidence. Otherwise, AFSA or ASIC aren't going to sign off on the notice. But essentially, to explain the concept, and I'll do it in a 139ZQ sort of sense. So a simple example is husband and wife own a property. Husband's about to go bankrupt. He transfers his share of the property to the wife for no consideration. Goes bankrupt. In those circumstances, it's a clear transfer of assets for no value or undervalue. And in those circumstances, once you get sufficient evidence, such as a valuation of the property, for instance, details of the security of the debt, secured debt on the property, then you make the application to AFSA for a 139ZQ, and provided you tick all the boxes, they'd issue the notice. As soon as that notice is received, it's registrable as a security on the property. So it allows you to cater the property, allows you to register security on the property, and prevents any further sale of the property. So the key is to move quickly and to have the evidence. Otherwise, you might find that property goes missing. So similar concept with the ASIC notices.
And the benefit there, I think, with the ASIC notices is that you don't necessarily going to have to go through all that court process, and it can be a lot cheaper than having to do all of that. and it pretty much almost like reverses the burden on the other side, because if ASIC's issued the notice, then they've effectively got to disprove the basis of what's under the notice. So it can be very powerful. It's just I'm not aware of a single one having it been lodged, but
No.
or even adjudicated on by ASIC. But certainly wait and see. I've seen two what I would say is potential legal Phoenix jobs that have come through to me over the last year, but unfortunately both of them are just prior to the date. So the date that I'm talking about is that the transaction effectively must have occurred after that February starting date in last year. So we wait and see. It might take a couple of years yet. But.
Yeah, I think it's a point of communication and education. Maybe it's perfect topic for one of your podcasts, my friend.
Maybe one
So
day.
I don't know if ASIC has really gotten the word out there sufficiently. So maybe that's the issue.
All right. So I just want to go through. So I think we could go on all day about different war stories and that. There's a lot more that you'd sent me that we could have easily gone through. But I thought we would just tie this up by maybe just shining some light to a few different stakeholders that might be listening. So I think starting with business owners and that, what's your sort of main bit of advice for any business owners out there that might be struggling with COVID, doing it tough because of all the restrictions and lockdowns and, financially. Do you have any little tidbits for them or stuff like that?
Well, it depends on what your particular issue is as a business owner. I think it's a pretty tough period for everyone. One of the frustrations I have as an insolvency practitioner dealing with business owners is they either can't read a balance sheet or they're not interested in reading a balance sheet. And if that would be my number one recommendation to anyone who's running their own business is learn how to read a balance sheet and learn what it means. That's just. If you're a business owner with insolvency issues, then obviously talk to your accountant. Tend to find that your accountant or your lawyer, whoever you've got the best relationship with, probably will listen at least and may be able to help you down the right path. I think if you get to the point where you're talking to an insolvency practitioner, try and have a coffee with them, perhaps. It is important that you have, if you are genuine about saving your business and restructuring, you're going to need to have a rapport with your friendly VA, with your friendly administrator. You're going to need the feeling of being able to work with them cooperatively, because I've seen both sides of the fence. Where administrator where I've been in an adversarial situation with a director, and it's just about impossible. You have to work together.
That's good advice. Next bit of advice for young professionals looking to either start in the external administration world, or they're already in it and thinking about becoming a liquidator. Any advice for any of those out there other than don't do it?
No, definitely. I think I thoroughly have enjoyed. It's a love-hate relationship. I think the insolvency industry can be. It can be hard work and stressful and all that sort of thing, but I've thoroughly enjoyed my 30-odd years, so I highly recommend it. I guess, our job's sort of easier these days in a sense, and in another sense it's not easier. In the old days, you would spend a lot of time talking to creditors, talking to the directors, talking to the banks, talking to the ATO even. Now there's not as much dialogue, there's not as much discussion, not as much conversation, mainly because you're emailing. In the old days, if a director had an issue, they'd ring me up and threaten to rip my arms off or something, and we'd have it out, and then we'd sort it out. Now it's just passive-aggressive emails, mainly. So as a youngster, I would say talk to people as much as you can. Eyeball the stakeholders. I know it's a bit difficult in the last 12, 18 months, but go and have a look at the property if there's a property. Go and have a look at the business and spend time understanding the business within reason. Obviously, don't spend the whole day there. It becomes cost prohibitive. But as a young person, get out of the office. But make it a worthwhile trip.
Yep. Oh, awesome. And maybe in a few words, getting your crystal ball out, what do you see over the next, say, 18 months, 2 years for, I guess the Australian economy or the insolvency profession itself in terms of the economy? Is it all doom and gloom, or is there, possibility of growth and fortune?
Well, I have zero economic credentials, if you like. So I'm not going to say how I think the economy will go. I suppose I can give you an opinion. I like the simple things.
Yep.
So I'm big on 15-year cycles.
Yep.
Property market, share market, the economy in general. I think we're getting sort of towards the end of a 15-year period of where perhaps there's going to be a dip, or when I say dip, an increase in insolvency work in a year or two.
Yep.
It's not an astounding revelation, really, is it? I mean, the percentage of insolvency work has dropped remarkably in the last year and a half. There has to be a lot of businesses and companies and individuals who are perhaps on ice. So I would say our industry is going to be quite busy in a year or two.
Yep.
What that means for the economy, I don't know. If it's another GFC around the corner or not, couldn't hazard a guess.
Yep. All right, awesome. So I think we're sort of running out of time, but I did have one quick last question, and then I'll end this and see if there's ask if anyone has any questions. But who's winning this weekend, Melbourne or Brisbane Lions? I asked because he obviously supports Melbourne, and I'm a big Lions fan. So
well, I'll tell you a quick story.
Yep.
I think it was about 2012 when I was quite buoyant about the Demons' chances. I bought a case of Melbourne Demons Shiraz, and I thought this will be good. I'll drink one of these every time they have a win.
Yep.
As of the start of this season, I still had 2 bottles left.
Wow.
So I'm possibly exaggerating a bit there, but so I've got them on ice in the expectation of being, and I thought, well, I'll keep these 2 for a grand final win, thinking they're well and truly off, no doubt.
There's still a great chance that Lions beat Melbourne in the grand final. You never know. But we should probably move on from that. All right. Well, thanks everyone for tuning in. If it might be because I'm looking on my own personal profile that I can't actually see comments in that. But if you do have any questions in that, we'll try to reply to them once we end the live, and we'll certainly be in touch. But we will try to roll out another, LinkedIn Live in the next couple of weeks. Firstly on my profile, and then on the SV one. We're just sort of working out logistics and that. But thank you very much for being my guinea pig.
Thank you.
Pleasure. Talking about the war stories from yesteryear, and thank you very much everyone for tuning in. Thank you.
Good.